Today's MarketSmith webinar. Today we're going to be covering interpreting pullbacks. My name is Scott Latonin, and I'm one of the product coaches here with MarketSmith. So the agenda for today, we're going to discuss the different characteristics of normal versus abnormal pullbacks. We'll look at a historical example of a model book stock from 2009-2010, just to reiterate the point. And then lastly, we'll run a MarketSmith screen to find pullback ideas and kind of discuss how to use those. But before we get started, just a quick mention about the question window here. If any questions do come up, we will have a brief dedicated QA session at the end of the webinar, but feel free to enter them in as we go along, and I'll make sure to tackle those at the end of the webinar. And then just a simple disclaimer before we get started that the content in this presentation should not be considered a recommendation to buy or sell a security, and that all information is intended for educational purposes only. And so with that out of the way, let's discuss the different characteristics of pullbacks and kind of interpreting what pullbacks are really for. So we all know that, even the best stocks are going to take a break eventually. Whether they go up 300, 400, or 500% from the breakout all the way up to their ultimate highs. But there's going to be multiple corrections along the way. They never just go straight up. And so you're going to be looking at 10, 15, even 20% corrections, from off their highs. And you kind of just need to realize that, if you missed it in the very beginning, these are opportunities to add on to the position or even get into it initially if you completely missed it at the beginning. And so it's always best to keep them on your radar because, like I said, they always pull back, and handling those pullbacks is crucial for long-term success. But one thing you definitely want to make sure of is that it has a history of bouncing off support levels. Sometimes the 10-week or the 50-day moving average is going to be your best barometer. Actually, sometimes the 200-day is going to be the best guide as far as your long-term general uptrend lines. You don't necessarily want to be buying off the 200-day or anything like that, but you'll see with some examples that they do find support there as opposed to the 50-day. But the 50-day moving average is the one we're going to use today. It's also the most common one. It's the one that institutions, pretty much use exclusively for when a stock is pulling back in. What is that long-term average price? What's kind of the agreed upon price there? And then lastly, if you're ever going to be buying a pullback or anything like that, you always have to make sure that you have a game plan for entering and exiting the trade. Like Charles Harris, one of Bill's portfolio managers, says at the Chart School workshop is, you got to plan your trade and then you have to trade your plan. It's easy to plan your trade ahead of time and to really know where you want to sell it and where you want to on the upside for a gain or even on the downside for a loss. But then executing that plan is crucial. Usually emotions get into it, and it's very difficult to really stay to the plan. So that's kind of the one thing I want to mention is that when you're buying a pullback, you're obviously buying in weakness. And so, the stock can get weaker very quickly, and we'll look at an example like that. And so with normal pullbacks, these are some of the characteristics that I tend to look for. Obviously they're not always going to be there, but this is just some general guidelines that I use for my own personal trading to help me kind of set expectations for what should or shouldn't happen with a specific stock. And so one thing that a pullback should definitely do is maintain a different support level. Commonly that support level is going to be the 50-day moving average. However, some faster moving stocks are going to use shorter term moving averages, whether it's the 10-day or the 21-day. Not that I really use those commonly. However, some stocks do tend to use those levels a little bit more frequently than the 50-day, especially if it's a very fast mover. Secondly, the breakout area. Most stocks, when they break out, you're going to pull back into the pivot zone at one point. And so you just kind of have to be aware that they will tend to do that, then also that they should find support there. That's an area of demand that should find more demand if the stock ever pulls back into that level. And then just the stock should remain above a prior low. And so this is kind of just your line in the sand that if your general uptrend is still intact, the stock should hold above this level, and obviously we'll tackle all of these during the example. And then the pullback should occur on relatively low volume. And I use the word relatively because I think a lot of investors get caught up on the fact that, if it's above average down days, they think all of those are necessarily bad. That's not necessarily the case. If you had a big gap up a few days prior, that's on 500% above average volume and the stock's up 20%, obviously that stock is at new highs. Institutions are looking at it. but you're going to get a lot of profit takers over the next few weeks typically, and so you'll see above average volume. So it's always relative. Your ideal situation obviously would be that the volume is very calm, it's well below average on the pullbacks, meaning that there's really no sellers coming into the stock. But we'll look at a few examples where that is and isn't the case. And then lastly, I think this is probably the most crucial one, is it should create an expectation of higher prices. If it doesn't create the expectation of higher prices, then you're really trying to catch a falling knife. Scott O'Neill, our president here, he's always saying, if you're going to be buying a bounce off the 50-day, make sure that it bounces first. And that's absolutely the case. If you're buying on weakness, there's no saying that the stock can't get even weaker before it goes higher, if it does go higher eventually. So you always want to have an expectation that the stock, quote unquote, should stop going down now, and that it should, and you should expect it to go higher over the next few weeks. And so those are the kind of the quote-unquote checklist of criteria that I use to kind of maintain, the normalcy of a pullback. And I just want to, just a quick side note, just because, I use these guidelines, doesn't mean that, all of these criteria have to be met, or in order to be quote-unquote normal, or that if none of them are met, then it's an abnormal pullback. It really comes down to having a feel for the stock. Some stocks are just going to be more volatile than others, and so and the market's always tough. It's never really easy, and so you kind of have to be aware of that. It always comes down to your feel for the market, your feel for the stocks, and that's kind of what this is trying to get at, is a feel for how the stock is acting. And so the example we're going to take a look at today is Cree from back in 2009, 2010. And so at this point in the market, this was one of the big winners out there. It had a phenomenal fundamental story. It does, super efficient light bulbs. And the earnings and sales were all great. And so just had that expectation that, this was obviously a can slim quality stock as far as the earnings and sales were concerned. So this is one of the better, fundamental and technical ideas out there in the market. And so you kind of have that initial double bottom breakout back in June, July of 2009, and it's gone up substantially since then. And then it pulls back into the 50-day and forms a flat base, and that's where we're going to pick up the stock. And so here's your ideal scenario where you're buying it on the breakout day when the stock's breaking out on heavy above average volume. And so that's assuming we bought it right there. And so now the stock has gone up almost 19% from the breakout in just, 6 or 7 days. And so that's a tremendous gain in a very short period of time. However, then the stock starts to pull back. It hasn't triggered any hold rules. The Bill's rule, if it goes up 20% within 15 days or 3 weeks, then you consider holding for a full 8 weeks. That rule hasn't triggered. So we're kind of on our own, so to speak. Usually we want to take gains at 20%. And we want to, get stopped out normally at 5 to 8% below the pivot if it stops acting right. And so in this case, it's in that gray area where it hasn't reached our profit target, and so now we're at risk of giving our entire gain back. And so this is a huge drawdown. So you're up 19%, and now you're only up 3.93%, and that's at the lows of today. That's kind of your max pain threshold. Was the lows of today, obviously. And so you kind of have to bear that in mind when it comes to your own trading, your own rules, your own portfolio management, your money management rules. How would you have handled that as an individual, and B, as a money manager? Obviously, you're managing your own money. Are you going to be able to sit with that? Because technically, and we'll look at the criteria here, it hasn't done anything wrong yet. It's moved up strongly. It's pulling back in nicely. However, your P&L in the position was up 19%. Now you're only up 4%. How are you going to handle that? And so what I would do is, and what I have done is, you need to go back and study this and say, okay, how would I have reacted? If you can do that realistically. It's tough, obviously, looking back in the past and kind of knowing what's going to happen versus what's going on in the market currently with so much uncertainty and not really knowing what's going to happen, obviously. However, I think you need to be realistic as far as, how much of your gain are you willing to give back? Are you willing to round trip it? If you're going up 19%, that's taking, going up 19% and then selling it at break even is not very fun. Obviously, I think we've all round tripped a few ideas. However, it's probably best to have a rule in place to make sure that you don't do that. But obviously, it's a very personal thing, unfortunately. So you're going to have to do a little bit of work in order to really, flesh that out. And so now, this is the day we're going to look at as it pulls back in. So I'm going to go through the criteria, the general guidelines for, is it a normal pullback or how's it shaping up? And so does the stock find support near a support level? And it obviously does. So as we know, like I mentioned earlier, that most stocks after they break out will pull back into their buy zones, into near the pivot area, and it should find support there. So it has indeed done that. It looks like early on in the morning it was down about 3 or 4%, and now it's closed at the highs of the day. Volume's obviously not high or anything like that, but volume isn't always as crucial. I think price is obviously a little bit more important. You get paid on price, you don't get paid on volume. So this is kind of just looking at the price here. And so we have a bullish upside reversal day here. So we did indeed find support near that support level. So I'm going to highlight that criteria in green, that it passed that quote-unquote criteria. And so now we have, does that lead to an expectation of higher prices? And it does, because now you would anticipate that the stock should move higher over the next few weeks or so. You have your 10, 12% correction in about 2-week time frame. And so now you've kind of shaken out a lot of the people that bought on that big up day. It was probably an earnings announcement. And so those that bought in there are probably not going to hold on to it. They're probably down 10, 12, 13%. So they probably got shaken out, which is what you want to happen. You want to shake out those weak holders. And now that you've shaken them out, your expectation is that the stock should move higher from here. So that is an expectation that we should have. And now we'll take a look at the relatively low volume selling. And this is that ideal scenario that I mentioned earlier, where you have that big move up, post breakout, and then you have a very calm and orderly pullback. And so look at the volume besides right after the earnings day. Right after that, there's 5 down days, and they're all on well below average volume. And so essentially no sellers have really emerged yet. The fundamental story, I would imagine, is still intact at this point. And now it's just a matter of kind of, taking a break, letting the stock, work itself higher. And so you do have the relatively low volume selling. So it's just obviously looking like a very orderly pullback. And then does it hold above a prior low price? In this instance, kind of your line in the sand, which I put a black line on the chart, is probably going to be your pivot. One of Bill's rules obviously is never let a substantial gain like 10, 15, or 20% turn into a loss. That's kind of your worst case scenario if you're up that amount. And so that's kind of your line in the sand, like I mentioned, is if you round trip this, that's probably where you want to get out. The model book stocks that I've studied don't do that. If you go up 10 or 15%, you're not going to give the entire gain back because something's wrong with the environment, or maybe something's wrong with that specific stock or industry. Maybe something else is going on. Who knows? But it should hold above that prior low price, and indeed it does. And so fast forward a few weeks, and we're at highs, and here's the day in question that we were talking about. And the stock has moved up nicely since then, and it's reached our 20% target. And so now, we're going to go ahead and sell it. We bought at the flat base around 39. It's gone up 20%, so we're going to go ahead and lock in our gains. And it's also a tendency to lock in gains here because if you think about it, the last time you got up 19%, you gave all but 4% of it back. And here you are, you're up 20 to 25% now. The last thing you want to do is give back, 10 or 15% of here. And so that's kind of the idea of having price targets in general, is to lock in gains on the way up. When the stock and the market and everything looks good, that's usually a time for a pullback or for, a slight, minor correction. The stock and the market never go up, day after day after day, unless you get some type of bubble market. Obviously, there are rare exceptions. But in a normal, quote-unquote, market, you're going to see, pullbacks along the way. And so we're going to go ahead and take our profits at 20% because we know that we should. It's a 20% gain in 27 days. It's about 5 or 6 weeks. And that's a very good profit. I mean, if you could do that over and over and over again, you'd have a phenomenal year every single year, especially with the whole compounding effect and everything. You could probably make an argument for maybe holding on for a bigger move based on the fundamental story and how well the stock has been acting with the amount of demand coming into it, et cetera. However, in this instance, we're just going to go ahead and take our gains at 20%. And so now we'll fast forward a few months, and the stock has moved up nicely since we sold it. We sold it around 48 or so. It's up in the 50s now. It actually reached 64 before pulling back in. And so here's the next, correction we're going to take a look at. And so here's the day in question where the stock has pulled back in about 15% in a few weeks off the highs. It's pulled back into the 50-day. And so, that's our first criteria is, does it find support near a support level? And once again, we'll do the same type of analysis. Last time it was the breakout area. Now it's the 50-day moving average, which I mentioned was the most common one and the one that I use pretty much more than anything else. And so here's the 50-day support, and it's definitely worth mentioning that not all stocks are going to find support at the 50-day. And especially just because a stock trades down to the 50-day doesn't mean that it's found support there. Usually you want to see this type of upside reversal off the 50-day signifying, okay, this 50-day line, people or investors have made this a habit of finding support there. They're going to go ahead and support the stock again, and the stock has bounced off the lows and is now up on the day. It's up about 1.5%. The volume's kicking in, and also it's closing near the top of the range. So that kind of leads to our next point, so it does find support, and that leads to an expectation of higher prices. So if you had traded this stock, this is probably the day you would want to buy a stock if you were looking to get back into it at a later date, but here's where you want to buy it. And your expectation at this point is now that it should go higher. And kind of your trade, I think, setup would be if it takes out today's low, you'd probably, or if it closes below the 50-day moving average, then that expectation would be wrong, and you could go ahead and sell it. So you're going to have your trade planned out ahead of time. But we do have an expectation of higher prices, so that's a pass. And here's the tricky situation with volume. So now we're going to look at the relatively low volume selling. And so in this instance, all of the down days are actually on above average volume. However, if you compare those down days versus the prior weeks of accumulation all the way up when the stock went from 40 to 60, a 50% move, and the fact that you had an earnings announcement there where the volume was up huge, that's actually relatively low volume. If it was an abnormal situation, or if this was really the top, you'd probably see a lot more heavy volume coming in, or maybe it would close below the 50-day, or it would be multiple gap downs in there. It looks like there's only one gap down, and so you could probably say that this isn't really abnormal, though this could be a gray area. Maybe some investors would say, you know what, I don't like that. Or, some would say, I don't mind. I'm in the camp that, this is relatively low versus the amount of net accumulation that has been going on over the past, actually not just a few months, but over the last year or so, when the stock's gone from 20 to 60. So there's a tremendous amount of institutional sponsorship occurring here. And so are they really going to let the stock, kind of falter here, potentially, obviously, but in this instance, we'll look at, it doesn't. And then does it hold above that prior low price? And so your key price, I think, at this point was the 52.66 low. If it had closed below there, then you'd probably say the general uptrends or the longer-term uptrend isn't as viable, or maybe it needs time to build a whole new base and to give it a little bit more time. But it does hold above that level, and so we do bounce off the 50-day here, and we go higher. And we're going to go ahead and, once again, lock in our 20% gain. So that's our second 20% gain in this stock. The stock's gone from 40 to 70 now, so it's actually gone up about, 75%? And we've only captured two 20% gains. However, we've also mitigated our risk because we're not sitting in the stock for those 15, 20% drawdowns. So if you're a person who is going to panic or sell at or sell when it's down 10 or 15% off the highs, then maybe holding on for a 100% move just isn't for you. It's definitely not for me, that's for sure. I would be panicking at this point if the stock was down 20% off high. And so we'll go ahead and take our 20% gain again, and we fast forward a few more months, and the stock's now up in the 80s and it's pulled back into the 70s. And so the stock's gone up from 40 to 80, so it's doubled essentially. And now we're looking at the stock right back at the 50-day. And so here's the day in question we're going to look at. And so the first one is, does it find support near a support level? Well, it's definitely at the 50-day, but is it really finding support? If we compare this day versus the last time it was at the 50-day, it's a much different type of day. So the last day, obviously, we closed off the lows. We closed blue on the day. We closed in the upper, what probably closed like 80% closing range on the day the last time we were at the 50-day. Now we're at this day at the 50-day, and the stock has closed at the bottom quartile. So we're closing near the lows of the day. Look at the volume on this day. It's above average. Volume has come back into the downside. And so we're going to say that it hasn't really found support. That's why you always want to wait for some indicator that the stock has indeed found support there before, adding to a position or before initiating a position off the 50-day? And do we have an expectation of higher prices? You really don't. You would really say, stock probably has to pull back in more. My expectation on this day would be that it goes lower before it goes higher again, if it goes higher at all. So we're going to go ahead and say, no, there is no expectation that it goes higher. And then lastly, let's take a look at the volume. And so in this instance, you can see that big day is downside volume, and that was because of an earnings announcement. And so you do see a lot of net distribution, especially when you get a bad break off the top when it's down, 10% down off the top. Those are bad days. It were actually very similar to back in January 15th, where you had a very bad break off the top before earnings came out and then went higher. And so in this instance, it was on the earnings, and then the stock tried to rally a little bit and then faltered and came back down to the 50-day. So we're seeing heavy distribution at this point. And then does it hold above a prior low price? And I think for me, I look at this stock and I say, okay, there's the low price that it should have held. It had a big earnings down day. It snapped back the next day. After going lower in the morning, it snaps back. It looks like if this stock is going to work, it should continue higher over the next few days. And so it does it. It actually takes out that low price and closes below it on above average volume. And so that's kind of telling you that maybe something's a little bit different here than the last time. Well, certainly very different from the last time. And so you probably just go ahead and avoid this time. Maybe wait for it to prove itself, or maybe wait for a new base to form. That's probably your best bet at this point. And over the next few weeks, the stock actually goes down 28% off its high in a very short period of time. And now this was because of the flash crash. But however, just because that was a terrible day, the stock was looking and acting very poorly before the flash crash. And you could say, blame it on the general market or anything like that. We're just looking at this stock within a vacuum to determine, does this stock exhibit normal or abnormal pullbacks? However, I always like to kind of keep these types of downside breaks on my screen. I actually print out charts of these type of action and post them up on my wall, just to kind of reiterate the point to me that the stock market, it can get bad very quickly. You can lose a ton of money in a very short period of time. And I think it's always best to kind of have that in the back of your mind that anything can happen anytime. And as much as you can try to mitigate risk, there's no such thing as eliminating risk. That's just kind of the risk that you take. Okay, so now that kind of aware of what types of sentiments to look for as far as pullbacks. Here's just a brief screen if you're looking to screen for pullbacks. Obviously when the market's in a correction, you're going to see a lot more stocks appear at the 50-day, and that'd be a great screen to run during a correction. Especially if the market's 5, 6, 7% off the top, you'll find a lot of stocks hopefully pulling back into the 10-week or 50-day moving average. And so if you're building a screen yourself, what you'll do is you'll just do price versus the 50-day moving average, and I put a band around the 50-day of 4% above and below the moving average, just so I can capture more ideas that are just near it. And so once I look at those stocks, I'm looking at the stocks near the 50-day. I want to see how they behave on a day-by-day basis around the 50-day. And so that's what this screen is trying to capture. And the next criteria, the price percentage change greater than 0%, it's just telling you that it's an up day. And so at least it's bouncing or it's a blue day. Doesn't mean it's a buy day or anything like that. It just means that it's an up day around the 50-day moving average. The composite rating I have is just over 90, so we're looking at the top 10 percentile of composite ratings. The composite rating blends the fundamentals and technicals together just to give you one rating, so I think it's the best rating that we have, which is why I use it so frequently. But we're looking at very strong composite ratings. And then lastly, just the 50-day average volume over 500,000 shares a day. So it's a stock that's relatively liquid. Obviously, I want to do a little bit more research to see which ones you want to buy. Ones that are big leaders or institutional favorites, etc. However, this is just a really good starting point. It's definitely a good idea to run the screen and look at them and say, okay, what are my expectations for these stocks? Kind of like what I was doing earlier with, do I expect this stock to go higher or lower? And maybe you could do if you were looking to study pullbacks, you could do like a mock portfolio of, okay, look at this day, what does that day have in common with other, support days, et cetera, and then maybe kind of do a results, where would you buy, sell the stock to the downside, to the upside, and just see kind of how that works out if you're looking to study a little bit further. Otherwise, what you could do is you can always customize your column layout. And so customizing your column layout is, let's say, for example, you had a list of leading stocks that you want to just add a criteria to, the 50-day moving average, or where the stock is versus the 50-day. Maybe it was the Growth 250 or the IBD 50 or, whatever list of leaders that you had. You just wanted to see where were those stocks versus the 50-day moving average. You can just jump into the customized column layout. You go to the price versus the 50-day. You can just drag that down into your preview, click apply at the bottom, and it'll refresh the list, and then you can sort the list by closest to the 50-day moving average. And so that'll give you a feel for how are the leading stocks? Are they all around their 50 days, or are they all well extended from the 50 days? That can kind of give you a clue as to kind of what part of the market cycle we're in. And that pretty much wraps it up for today. So just to put everything into practice, just kind of go through and study the different characteristics of pullbacks. Like I mentioned, these are just guidelines that I use. Guidelines, definitely, I wouldn't say rules per se, just kind of guidelines to help you get a feel for the stock. Because you definitely want to, at least in my opinion, you want to be trading off of feel, because that's really the only way to really really know how a stock is acting well or not. But go ahead and study the characteristics, kind of see what works for you. Go through and run different screens to find pullbacks within leading stocks, especially if you're looking to, maybe you're underinvested or you're looking to add to existing positions. That could be a beneficial scenario where the stock is pulling back into the 50-day moving average. You have an expectation that it should go higher from there, etc. And then lastly, this is probably the most crucial aspect, is plan your trade and then trade your plan. Everyone can always say, okay, well, I want to buy at the breakout, I want to sell up 20%, or I want to sell down 7% as I stop out. You probably want to have a little bit more detail, just because there's a lot of gray area in between there. If the stock's up 10, 15, 7, 8, 9%, maybe then the market goes into correction. How are you going to handle that? It's definitely good to have different scenarios in your mind, so okay, if X happens, then Y is the result. You can kind of plan your expectations ahead of time. And so with that out of the way, let's go ahead and just turn it over to you and see if anyone has any questions about maybe pullbacks or about MarketSmith in general. Okay, so a question is about, how does the relative strength line help in your analysis? It obviously can be very beneficial, especially if you're looking to kind of identify leaders in the first place. You want to look for stocks that are outperforming the S&P 500, and so you'll see the relative strength line, moving upwards. What I would do is we have a whole webinar dedicated to the relative strength line that you might want to check out, just to kind of get a feel for maybe how we use the relative strength rating and the line in-house. But for me, usually most stocks are going to correct back to the 50-day during times of weakness in the market, and especially because they're growth ideas, primarily momentum stocks, to be honest, they're going to pull back pretty sharply. So if the market pulls back in, 2, 3, 4%, the leading growth stocks are probably going to pull in, 5, 6, 7, 10% off their highs. And so you kind of just have to be aware that, if it can move up faster on the way up than the market, then obviously it's going to move down faster than the market as well. So you just kind of have to be aware of the qualities of the stocks that you own. But what I would do, I tell everybody, is if you think the relative strength line is important, or if you don't think it's important, just go back and study it and see, okay, well, I'm looking at these model book stocks, or stocks that have done really well in the past. What happens with the relative strength line as the pullback develops? If you can develop a rule for yourself out of that, then that's more important than anything I could ever tell you. Okay, so there's a question regarding the first pullback on CRE. I'm just going to go ahead and pull up the first pullback. Okay, so here's the first pullback on CRE. And so looking at the first pullback, was it a sell signal on the trend line break? The first before the 50-day moving average pullback to the flat base. I'm sorry, I just don't quite understand what kind of trend line was broken. So unfortunately, I just don't quite understand the question, so we're going to have to just skip that one. It's definitely good to have a watch list of stocks that you plan to follow. So like I mentioned, if you have a list of leading stocks that you think, okay, these are the top 15, 20, 25 ideas in the market, then you should definitely go through and say, okay, where are they versus the 50-day? Go back and study the pullbacks to the 50-day moving average that they had. How did they react around the 50-day? Like I mentioned, you always want to see that the stock has had a history of pulling back in and finding support there, before really entering a trade. You always want to have your expectation that the stock should find support there and then move higher. But I think that pretty much wraps it up. So I'm going to put our contact information up on the page. So if any questions come up going forward, it's 1-800-424-9033, or feel free to email us at reachus@marketsmith.com. If you do social media, we're on Facebook and on Twitter. Our president, Scott O'Neill, he'll do an occasional blog that we'll tweet out the link to, and he'll also do occasional tweets on the market from time to time. But like I said, if any questions come up going forward, definitely feel free to reach out to us. That's what we're here for. On behalf of myself, the rest of the team here, appreciate you all attending, and have a great day.